gentlemen, welcome back to the MPIRE Financial Podcast. With you today, your host, Waldry, Marte. Some people call me Marte Money Baby. And with us today, I have a really special guest. But before I mention who the guest is, the reason you are here is because you want to learn about finances. You want to learn about how to improve your credit. You want to learn how to buy a property, how rental properties work, how you can invest into real estate, how you can invest into your financial future, how you can retire someday. What are the things you need to have? Is it a will? Is it a trust? Is it an estate? That's why we're all here, and that's what you're going to learn. And we're going to continue to bring you the best content in English and in Spanish, by the way, because Edwin has been killing it with these videos. Shout out to Edwin, my business partner. He helps with the production. He comes up with good topics. He gets great guests, and he helps edit and make this happen, baby. With us today is a friend and a mentor. I started working with him about 8 years ago, maybe a little longer, right when I was getting into real estate. He really helped me understand what is commercial, what is rental loans, and how does hard money work. And I really wanted to bring his knowledge to this podcast so you guys can also hear from him on the do's and don'ts for rental property and bridge loans and what does that look like. He's been in real estate for over 20 years, I believe. And the guy is just a beast and a pleasure to work with. So with us today, I'm going to introduce the owner of FundRoll Capital, Mr. Jerry Landau. You can call him Jerry, though.
Thank you so much. I appreciate being here. I want to thank Edwin, Waldry. It's a great honor being here today, talking about real estate, trying to bring on new investors, people that could understand what we do here today.
Listen, Jerry, I need you to be a little happy to be on the
You want me to be happy? Bring it up. Bring up that level.
This guy. Every time I call Jerry, Jerry's just screaming, "Oh!"
Can't do that alone.
You know, I take great pride in making sure I can help almost everybody, but I think I try to break the straw on Jerry's back too often, trying to help some of these people. You know, oftentimes, or not oftentimes, but sometimes we get a client and we have a like a nickname or a theory or whatever you want to call it. Los clientes tan pudridos, tan dañados. In English, that means that the clients are rotten. They're messed up inside. They have a disease and they can't get funding. And not literally physically sick, just financially sick.
That's when they bring them to me. Then they go, hey, how are we going to make it work?
Yeah, so, but Jerry oftentimes, 9 out of 10 times makes it work.
We try to make them work. That's our plan here. Our plan here today is to actually figure out how to make everything work.
So tell us a little bit about you before we get into the topic, you know, who you are, how you got into real estate, and a little bit about your company.
Sure. So I appreciate that. Again, my name is Jerry Landau. I'm with a company that's called FundRoll Capital. I am the owner of a direct national mortgage company. What we do is we do mortgages for investment lending across 44 states. I've been in the real estate game for over 25 years at this point. I've been doing what we call the BRRRR Method before the acronym actually became out there. Clearly, again, I believe it's the best way to buy real estate. When you're buying a piece of real estate that's distressed or in a foreclosure, you're going ahead and taking that opportunity to add a value to that property by creating rehab, maybe some construction, fixing the property up, and then going ahead and refinancing that property out and getting all your money back. The ideal situation. Personally, I could always say this, is that I make friends. Why do I make friends across the country or for many different investors? Is because when you actually get a refinance cash out from FundRoll Capital and I hand you a check for $35,000, you're always going to come back to me. That's where we are, okay? The idea is that cash out refinance is where we actually excel at what we do.
I think you're being a little modest, though, Jerry. I mean, just yesterday, we closed a deal here in this office, and we handed them an $89,000 check. Okay, so $35K is definitely on the low end.
Well, you know, I got to be on the low end a little bit sometimes. You know, I don't want to tell everybody we're going to $89,000 checks out. I think I did one with Edwin. I think somebody got $185,000.
There you go.
You know, I mean, but you know, they're not always going to happen that way.
35 plus.
35,000 plus. That's the minimum we hand out.
So BRRRR, what is BRRRR? Do you know the acronym? What does the acronym mean?
Acronym for the BRRRR.
The BRRRR method is very simple. It's when you buy a property, you renovate it, you rent it out, you refinance, and then you repeat. It's simply an acronym for doing what Jerry has been doing for over 20 years in real estate. And no one really used this acronym, but it became popular over time because it was easy to remember, right? So that's what the BRRRR method is. So let's break that down real quick though. Everybody know what buying real estate is, and we've already talked that in a previous episode where you could find deals and what you could do. But let's talk about the renovations. You got to get a contractor, someone that knows what they're doing. Hopefully doesn't cost you too much money. So it's, you
Get a
can
contractor.
add value to the property.
In order for us to actually do a BRRRR, which again, what we're talking about originally, is that you are trying to do a bridge loan or a hard money loan. That means you found the house for a dollar amount that's been accepted by the seller, and now you're going to go ahead and get a loan. And that loan is actually going to be what we call a rehab loan. And that loan means that you need to go ahead and get a contractor with a scope of work.
Yeah.
Scope of work is actually going to be about what are you going to do to this property. And once we have an understanding, we're going to hire an appraiser. Once we hire that appraiser is going to give us the most important number that we're looking at. And that is considered the after repair value. So the after repair value is what we're going to be lending on. And that's what we're looking to do. The more money you have on that after repair value, the more the appraiser actually says this house is going to be worth after you do your work to that property or the contractor does. And that's what we're looking to do.
The ARV, after repair value, is such an important number for real because that will make or break a deal. If you're putting X amount of dollars into a property, you think it's going to triple the value, the appraiser is going to go out there. He's going to look at properties that recently sold with the similar repairs that you put on your scope of work to see if in fact those repairs will execute the value to be at the whatever the comps are, right? So what are some do's and don'ts for a bridge loan or a rehab loan?
Sure, do's and don'ts. That's a great question. So what we're looking at here is one thing about it though is that you never want to have or set the number of a property in an area. You don't want to go to a community that has if you're doing a construction loan, you don't want to go ahead and go into a community that has a lot of ranch homes and then expect that you're going to add a second level because that's gonna not really.
It's not comparable.
Not comparable. Great word. I appreciate you filling that in for me. That was wonderful right there.
My brother.
That's always amazing how we figured that out. You don't want to be the highest price point in the neighborhood. You don't want to be.
Why not? Why is that? What's wrong with that?
So let's go over. When we're sending out an appraiser who is a totally independent person, and that person doesn't know what your plan is to do to this house, they're just looking at the scope of work. And then, of course, they look at that you're trying to do or exceed something in the neighborhood. They have to do a comparable with the other houses in the neighborhood within a certain mileage area, okay? At certain zip code. And if they can't find anything like that, what you're going to do is you're going to get a very low after repair number that you are expecting. And at the end of the day, that's not really going to work out for you because you're not going to be able to sell that house or refinance it later on down the road.
If you're trying to renovate a house that in the property, the average house is $500,000 and your renovation could potentially add that house value to $1 million, you may not get that $1 million value because the comparables within a certain mileage usually don't go more than 1 or 2 miles outside of the zip code. There's no comparable houses for $1 million in that neighborhood. Now they cannot give you $1 million. They might only give you 600 or 700, even if potentially could be worth more. Houses in the area do not sell for that price, which is why it's so important for you to look into your local market and find out what houses are really selling for and what kind of repairs people are doing to that neighborhood, so that way you kind of follow the trend and get the highest repair value. And at the same time, if your numbers don't work in the neighborhood based upon the budget that you're trying to spend, you're either getting the house for too expensive or you're doing too much work to the property. So guys, pay attention to that.
That is correct. You want to stay within a certain budget. If you come to me as the lender, or you're speaking to Waldry or Edwin, and we're lending to you a certain amount of money on that scope of work, that is the budget you need to be working with. You don't want to exceed that budget. You don't want to take money out of your pocket. If you take money out of your pocket and you think, oh, the more money I put in, the house is going to be worth more at the end, that's probably not going to be true. And what's going to happen is now you're going to sell that house and you're probably not going to get the value price point that you want. So please, at the end of the day, what we all understand is that we're working here as a partnership. with everybody that comes to us, and we are looking to make sure that you're in the right deal with the right amount of money in order to actually be successful.
So once you bought the house, you renovated the property with a bridge loan or rehab loan. Now you're going to do what? You're going to rent out the property and you're going to refinance the property.
Good.
Why is it important to rent out the property before you refinance? Why not refinance it and then rent it out once you have the $35,000 in your pocket?
So when we're talking about doing an asset-based loan, which some people call them DSCRs, debt service coverage ratios, we're looking to have the tenant there that they're already paying income.
Mm-hmm.
So when we know what there's income coming into the property, we're not looking at tax returns. We're not looking at personal income. We're not looking at your W-2s. It's all just about what that house is going to be worth. And of course, the most important now, we're looking at rental income. Rental income needs to pay the mortgage, the taxes, and the insurance.
So at the end of the day, every single mortgage, Jerry, needs to prove the ability to repay that debt. And when we're talking about an asset-based loan, that loan is based upon the asset that is securing the mortgage. And in this scenario, the asset is the rental property. It's important to rent your property first because that rental income is what's covering the debt ratio, right? The debt on the property. And you need to rent out the property for how much more than your mortgage?
If you are actually just $100 more than what the mortgage, taxes, and insurance is, we'll still lend you money. But that's not a very good investment for you because what's to make $100? The answer is that we always like to see investors, people that are going to be landlords. Again, you're making at least between $300 and $500 per every property that we do.
At a minimum, $300 or $500. I mean, I don't know about you guys, but I would not buy a property, put on this money, buy it, rehab it, rent it, refinance, and do all these things, all these steps to only make a couple $100. I might as well just do a couple Ubers and I can make an extra couple $100 and not have to have a headache.
The great thing that you're actually missing out on the refinance, though, is that we're giving you back that check.
Ah,
That's because once you get that check back, we've covered your down payment. We've covered the scope of work, which is the money that you put into the property. And now you're basically walking away with that check. That house hasn't costed you a dime at this point. You got a home for free, which is with a tenant in it that's paying your mortgage.
wait, hold on. You got to break this down for me, Jerry, because honestly, I'm not understanding this.
Did I go too fast on that?
You went a little fast, and I'm a numbers guy. Talk to me numbers. So you bought the house for X.
Bought it for X.
You invested Y.
You got Y.
The house is worth more.
Now we're talking Z.
So then how do you get to 3.14 in pi? How do you buy for X, invest Y, and now I can cash out Z?
Well,
How does that numbers work?
Again, those numbers have to work. It's the only way that we could actually lend you money. So the answer is that if those numbers work, X, Y, and Z, then you need to actually give us a call because we want to actually fund that project.
And if you want to know how those numbers work, you're going to call us and we'll give you the actual numbers because we got to incentivize you to call us, okay? We got the information, you make the call, and we get you the money, baby.
Marte. Get you the money.
I got a little Italian there or something. I don't know what happened.
Spanish and Italian.
Yeah, Spanish and Italian. It's the green. So you refinance. No, so in all seriousness, the bank will lend you up to 75% of the property value. So you need to make sure that
cash out
on the
refinance.
cash out refinance, correct. So you got to make sure that by with the purchase price, the renovation, and all the costs, that number is less than the 75% of the value of the ARV, the ARV. So you've mentioned that you can use the DSCR loan, the asset-based loan, for a refinance. Can you use a DSCR to also purchase a property if it doesn't need like renovations?
Absolutely. Basically, what you're doing is you're just buying a DSCR loan, and that's going to be a rental property. So it is something that's available to you. Many people do it. Clearly, again, it's all about if that's something that you want to do, because getting involved and fixing a house up and doing construction and dealing with contractors is work. So you have to be able to say to yourself, do you want to have this work in order to get to the goal, which is the ARV, the after repair value?
So we know that on a purchase DSCR loan, the maximum loan to value or the minimum down payment is 20%, maximum loan to value 80%.
Correct.
Depending on your credit score and the debt service coverage ratio.
100%.
However, you mentioned earlier that the property needs to be rented out when you do a refinance. How about when you purchase it? Does it also have to be rented out?
The answer is no, as we are going to hire an appraiser who's going to go to that property and give us what we call fair market rent. So we do not have to have that property rented out at the time of purchase.
So on a refinance, the property must be rented out, but on a purchase, it does not because of the appraisal.
So what we do have is that you could buy a property. We don't expect the properties to be rented when you're actually buying them on a DSCR. So what happens is that most landlords want to be able to put in their own tenants.
Yes.
Okay, because they don't know that other tenant. That other tenant might not be paying rent on time. That other tenant may be actually doing certain, that other tenant might be causing different problems to the property. So you want to be able to actually do your background check and find your own tenants. So we don't expect those properties to be actually tenant occupied on the time of purchase.
Thank you, Jerry. I really appreciate that answer. Now, my next question here is, what are some do's and don'ts for a DSCR loan, whether it's for a refinance or a purchase? Or, let's go through both scenarios here.
Okay, well, we're talking about, the question is, let's talk about the don't. Not so much about the do.
Yeah.
Okay? The don't is what you're trying to do is that you're ready for a refinance. Okay? I'm a real estate landlord. I am an investor. What you want to be able to do is make sure that you have all your documentation correct. What does that mean? We don't want to have a lease that you give us that expired a year and a half ago. Okay, because again, now we're going to ask you to go to your tenant and get a new lease.
Now, what happens if the lease has that clause where it turns into a month-to-month? Do you still require a new lease?
It could turn into a month-to-month, but the question is that we'll let that go for 6 months. We can't let it go for 2 years just on a month-to-month like that.
Right.
Plus, besides that, I can tell this to all your landlords out there. If you actually are still going month-to-month, you're losing out on rent. You haven't increased that person, but your utilities have increased. Everything that you have on that house, property manager increased your bills.
How about the collection of rent? How should a landlord not collect the rent versus how they should?
Well, let me explain to you. I got into this business 25 years ago, and the reason I got into this business is because I actually like collecting rent. And I got collecting rent because it was cash. So that was my biggest day. I used to love going around knocking on everybody's door and collecting all my money. Right? I mean, that was a fun day for me. The answer today is that there's so many different types of apps out there. You got opportunities, you got property managers, but so you should be able to go ahead. You can use Zelle, you can use Venmo. You should be able to collect rent today without going ahead and knocking on doors, collecting cash anymore.
So what you're
Still
saying,
fun, but you don't need to do it.
so what Jerry is saying here is that it's important to document the receipt of the cash, the rent rather, that you are receiving. It's difficult to document a cash bill that you are received because there's so many applications, there's checks, there's different ways to document the receipt of actual rent.
When we're going to verify that the rental income is coming into a particular bank account, if you are collecting cash and not depositing that, there's no way for us to do any verification. Well, your property manager, many different apps out there are available to you, Zelle, Venmo, or again, you could always get a check the old-fashioned way.
What else should a landlord not do with a DSCR loan?
Okay, so what a landlord should not do in terms of a DSCR loan is, remember, this property is for an investment only. We're closing, as we are providing to you a mortgage, it's for non-owner occupied. Repeat that to you, non-owner occupied is what a DSCR loan is for.
So as you guys have heard, there are certain things that you should not do when trying to refinance or purchase a property with a DSCR loan. Now I want to know, Jerry, what are some of the advantages of going with a DSCR versus applying for perhaps an FHA or a conventional loan?
DSCR loans, asset-based lending for investment properties. We're not looking at your personal tax returns, business tax returns, no W-2 income. So what we're looking at is strictly that the rental income is going to pay for the mortgage payment, the taxes, and the insurance. Easiest, cleanest way in order to actually close loans, we actually do them in 3 weeks. So if all your documents is in place, 3 weeks closing, you got a check in your hand.
So aside from not having to verify your personal income, what other benefits are? I know we do a lot of these loans together, and hardly ever we close one of these in a personal name. Can you talk a little bit about that?
Well, we don't close them in a personal name, but we can. But we hardly don't is because Most people, in terms of making sure when you're buying real estate, you always want to be able to have some protection and close that in an entity LLC. That just makes that you go out and you do a business registration for your business of being a landlord.
So when you say protecting yourselves and using the LLC, what exactly does that mean? How does an LLC protect you? Is it like what is that?
So when we're actually talking about why do you go ahead and get an LLC, it's basically allowing you to be protected on a real estate investment property. It's giving you the protection. So if you got into a car accident, if somebody fell on your property, if there was an accident somewhere, they're not going to be able to sue you personally. They're only going after the entity name. And of course, because it's a business, it's probably all going to be paid off by the insurance company.
And not just even that, just to add to and piggyback what Jerry's saying, also a DSCR loan closing under an entity will not go under your personal credit.
Biggest thing. That's the biggest.
That is the biggest thing.
Biggest thing is that I have many clients. They own 20, 30, 40 properties, and none of those mortgages appear on their personal credit.
I would love to be one of those clients for you. Shall get there.
We're gonna close Waldry's loan next week.
Oh, nice. $35,000.
Right?
Let me just inform some of our audience here. So I'm also licensed to do residential loans, FHA, VA, USDA, and such. Normally, before DSCR came out, a real estate investor would buy a property one of two ways, either cash or they would buy it with a conventional loan. However, a conventional loan, you could only get up to 10 or 14 properties under your personal name. And as you can imagine, I mean, you've got to be making a lot of freaking money to be able to afford 10 or 14 properties in your personal name and prove it, right? You got to be reporting a lot of income.
You still need to be able to show that you have 10, going up to 10 mortgages in your personal name, because that's the way you had to close them back then. No business entity. And you did, of course, have to be able to prove that you were able to have the income. It's just, I mean, for some people, you got to run out of money at some point. I don't care how much money you have. It's just impossible.
Even the smartest guys know where to cut it off. And that's me right now. Guys, it's been a pleasure to have you here. Thank you for tuning into the MPIRE Financial Podcast. Thank you to Jerry Landau for coming to our office and recording in our studio. It really has been a pleasure to talk to you here. You're going to find more tips and tricks and BRRRR methods and everything else. So tune into our next episode so you can find out more information. See you later.
See you later.